What's going on, guys? Welcome back to the channel. My name is Leo, and in this video here we're going to be doing a stock analysis on Microsoft. Let's roll the intro, jump into it. We're going to look at the company metrics first, and what we'll do here is compare where the company currently is to where the average is, try to grab an idea. So we have our PE ratio at 31 compared to an average of 34. We want this to be under 22.5. Guys, we're not hitting those numbers just. EPS is our earnings per share. We want this number to be ideally over our 5-year average, which we have. We have it at 9.47 compared to 4.79, which is phenomenal. That's always good to see. Return on equity, we want this number to be over 15%. Current return on equity is 48%, which is phenomenally high, and our average is 33. So double what we're currently looking for the 5-year average, and triple that for what's currently happening for a trailing 12 months. Profit margin 38% compared to an average of 27.44. So that's awesome. They are improving on their profit margin. Revenue is 184 billion. Net income is 71 billion. Free cash flow is 60 billion, with an average free cash flow of 40 billion. Okay, so we're up on our free cash flow average, which is great. And something to keep in mind is that they do pay out a small dividend of 0.78%, as we have here, which equates to about $16.5 billion paid. Now, there's something to keep in mind, folks, when you're buying a company that pays out a dividend, is can that company continue to pay out the dividend? And Microsoft is able to do that no problem with an average free cash flow of $40 billion. Even if they doing that same number, it wouldn't cause an issue for them. And now the current free cash flow is around $60 billion, and they've recently made headlines with the acquisition of, or at least putting through the deal of acquiring Activision for around $69 billion. So their free cash flow currently $60 billion. It could just be an all cash deal, guys. That is an impressive number. Return on invested capital, we're at 29%. We want this to be 10% or higher. And for our 5-year average is 20. Currently, it's almost pretty much 30. It's like 3 times more than what we need it to be. That's phenomenal. That means that they make a great return on their capital that's being invested. So that's awesome. They're allocating capital effectively. Next up, we have Altman Z-score and Piotrowski score. So Altman Z-score, we want this number to be over 3. Currently, it is at 9.53. Now, something to keep in mind, though, is with Altman Z-scores, it typically is designed and used towards companies that have a lot more tangible assets, but it doesn't really apply so much more to Microsoft. So although an impressive number, it doesn't really apply much to a tech company. Next up is the Piotrowski score. Now, we want this number to be between 8 and 9. 9 is a perfect score. And what this does is compares return on assets, the increase of assets or decrease of liabilities from a year-to-year basis. And the company will earn points if it follows through with some of the categories. Microsoft is doing that, so it gets an 8 out of 9. So far, I'm liking Microsoft. The one thing that is kind of a little bit of a bummer for me is that their PE ratio is 31 compared to what we want it to be is under the 22.5, because you don't want to overpay for this growth. However, companies that are growing fast are going to they're most likely going to have high numbers. So let's go over to our financial evaluations here, and then we'll try to determine if this 31 is a number that's somewhat justified. So onto our financial evaluations, we've scored a 9 out of 10. As we discussed, our 5-year PE average is 34.64. We want this under 22.5, so it gets no points there. However, current ratio is 22.25. We want this number to be over 1.5. Now, what this metric represents is how many assets does it have on hand to cover their liabilities. 1.5 is a healthy amount because you would have zero point 0.5 more assets on hand. Let's say if you liquidated a 1-to-1 ratio of assets to liabilities, having this number here, 2.25, Microsoft is in a very good position. Return on equity average, as we discussed, over 15%. It's at 33, so it gets a point. EPS growth, we want this number to be increasing as a shareholder, and it has a 712% increase over the last 5 years. That is phenomenal. So it earns a point. Next up is debt to equity. We want this number to be under 50% because we want to see the financial leverage being built up through equity and not through debt. So 42, that's a great number to have. And keep in mind, folks, like this is a $2 trillion company. Microsoft has been around for a while. So it's, in the eyes of many investors, it is blue chip, right? But it's good to see that like there's still a lot more runway, it seems, for this company. Share dilution. We'll go on to that next. Share dilution is the company has been decreasing shares by a small percentage of 0.83%. It is minuscule, but we want to see this number obviously decreasing or staying the same. That means you, the shareholder, will obtain more ownership of the business. So they've been doing that. It gets a point. 5-year net income growth, it's at 188% increase over the last 5 years. That's a point. Free cash flow growth and return on invested capital average is 20%. So we have free cash flow growth, net income growth, and revenue growth also at 14%. That is pretty, for a $2 trillion company, that's pretty large. I would have to say that's pretty big. And obviously our 5-year return on invested capital average is 20%. We want that to be 10 or higher. Yeah, all positives across the board. So as I was saying earlier, we had to figure out that this PE ratio number, this 34 number, is justified. With what I'm seeing here over the last 5 years, just on these metrics here, it's something I could probably just overlook. I mean, I could probably maybe just turn a blind eye to it because I see that the company has been growing by a considerable amount, and there's a lot of runway still left for this business. But before we get to that full conclusion, let's jump into a price analysis to determine what we should be paying for Microsoft. So we're going to do 3 estimates here with 10 years of evaluation. We're going to look at our numbers and we'll try to figure out what we should be paying. So I'm going to stick within the 5-10 year number here, 9 being our low side. So I'm going to go with I'll go with 8, 9, and 9.5. We'll just do 10. We'll just do 10. Revenue growth. I want to be conservative here because if I'm not conservative, I don't want to put myself in a position where I want to give myself a decent margin of safety, right? Because they very well could be hitting 14% growth per year. I mean, last year they did 17% growth, but if these numbers hit a low percentage growth, that would give me a lot more confidence in investment and from an investing perspective. So 33, 31, 31.57. Free cash flow margin. I think they've been pretty consistent with that 31 mark. So I'm gonna go 31, sorry, 30, 31, and then maybe 31.5. So some wiggle room here. In price to free cash flow, we have 36.48. I like doing 14, 16, and 18 on the high side, and then we'll do 14, 16, and finally 18 for our PE ratio. And then desired return, we'll do 13%. And okay. So guys, it's kind of what I predicted because we're chopping this essentially in half in the PE ratio and also the price to free cash flow ratio. We are chopping essentially this in half, and it is reflected here. For this company to make sense, it is showing that it is overvalued, and a fair price to pay would be if this company were to fall in half. The numbers I'm really looking for are numbers that kind of fall into this conservative category, and maybe this moderate category. But our aggressive category is, I mean, it's 215 on the average, 295 currently, and with an average of 177. Yeah, I think Microsoft is a phenomenal business, but I'm gonna stay away from it. I'm gonna put it on my watch list, but it needs to hit, I think, but yeah, at least 150, somewhere between here. So you're probably wondering why I want this company to fall in half, because I do truly believe you can overpay for a business, and I want to get just a fair value before I put my money down. I'm confident Microsoft will be around for over 10 years. I'm confident that they'll continue to make great products, and they have a lot of things in the pipeline. Um, Especially with this Activision acquisition. Activision acquisition. In terms of the gaming space, there's a lot of opportunity there to further grow their business. And with a 14% revenue growth over the last 5 years at a $2 trillion evaluation, like this behemoth of a company is showing no signs of slowing down. Um, yeah, no complaints other than the current price. So from a 295 perspective, I need this to come down to about 150, and then that will be a buy for me. But those are my thoughts on Microsoft. Tell me what you think. Tell me what you think about this software. Drop a comment down below, hit the like button, hit the subscribe button, and I will see you in the next video. Thank you guys for tuning in. I'll see you in the next one.